Well, it's time for another Rogers Capital market commentary where we attempt to be the antidote to water cooler wisdom. Well, good riddance to February. Another down month. After what was a real strong December, we had a nice holiday season. Markets were up over 4%. We followed it up with a tough January and February, and even not the best start to March so far. Down 5 in January, down 3 in February, and so far down about 3 as of the first week or so here of March, which puts us in correction territory. Now, we've talked about corrections being normal. Repeatedly, we've discussed, you'll remember 4 and 1. And 1 in 4, that 4 times a year, 5% pullbacks, normal. Once a year, 10% correction, normal. And then, of course, every 4 to 5-ish years, a bear market, which is defined as a 20% downturn or more. Now, the last time we had a correction early in the year like this was 2020, and then before that 2016. And in both of those instances, we clawed back and finished up with a pretty nice year. Now, what sent us into correction territory? Russia. Now, of course, our hearts and thoughts are with the people of Ukraine, this humanitarian crisis, this chaos. And really for me personally, just kind of, the thoughts of how blessed I am to live in a country where it is unfathomable that I would have to deal with what these folks are dealing with. But humanitarian crisis aside, investors must remember that market volatility in the past, and with the geopolitical events like this, have been short-lived, and the recoveries have been quick to follow. The best example, closest historical example to this, is the invasion of Kuwait in 1990. Markets over the next 10 weeks, 2.5 months, were down 17%. But 6 months after that, we were fully recovered. Now, the U.S. economy today, helping this situation, is strong. And we're somewhat isolated from the immediate impacts of this. Europe obviously being a little more impacted by this. What's more worrisome for us is the conflict is hitting us where we're already vulnerable. Inflation and gas prices, energy. Commodities are surging. Wheat, nickel, a lot of our metals, copper, and of course, the price at the pump is going through the roof. But here's some good news. Recession risk is still low over the next 12 to 18 months, let's say. And we've had some nice job gains. We added 700,000 jobs in the month of February, which puts us now at 3.8% unemployment and a 62.3% participation rate. That puts us just 1 percentage point within the pre-pandemic level. We've also got a strong consumer, a very healthy American household, American kitchen table. We've got strong corporate balance sheets. We've had strong earnings through this first quarter. COVID is waning. Have you noticed how little you've heard about COVID recently? Where did Dr. Fauci go? I don't know. He must be on vacation. And I think part of this too, while you hate for people in Ukraine to go through this, here it's likely to lead to a more dovish Federal Reserve. You'll remember we've discussed multiple times that one of our concerns is that the Fed would be more overly aggressive, in raising rates, which with all this going on seems less and less likely. Now, the bottom line, as you well know, I have no crystal ball, but my eyes on the forward projections, the historical cycles. This world is crazy, no doubt. And I know that many of you are wondering whether our leaders are capable of handling this and fixing things, and maybe sometimes even interested in helping the situation. But this is why we have a time-tested process. Allocate, diversify, rebalance. And it's not just for good times. In fact, it's developed exactly for times like this: volatility, uncertainty. Now, I'm happy to talk or Zoom. It's what I'm here for, to allow you to think and worry less about money. But for now, turn off the TV. Seriously, turn it off. Go outside. Get some sun on your face. Better yet, take somebody who's important to you to lunch or coffee. Do something that matters. Be a blessing to somebody. And here's hoping that things calm down a little bit here in March and April or May. Maybe we can get back to talking about some fun stuff like bonds or estate planning or insurance. We'll talk to you next time.